Welcome everyone to the Daniel Coogan Associates Wealth Management Review for May 18th, 2023. What we're going to be going over today is the quick market update, the debt ceiling showdown, portfolio positioning, and we'll wrap up with any questions here at the end. So,
all right.
Welcome everyone.
Yes.
Good to see you.
You know, I just noticed something. We're
both wearing blue.
Yeah, we're matchy today. So
okay,
there you have it. Actually, we're completely matchy because you got a blue cup, I got a blue cup. Yep. Although my cup is smaller than your cup. Why is that?
I don't know. Different types of coffee, I guess.
Yes. All right. So where do we want to start today?
I don't know. Market recap?
No. Yes. Market recap.
Let's
do the market recap.
Okay.
All right. So let's go ahead and move in. We're going to take a quick look at the markets today. The S&P 500 and the bond volatility. And this goes through to May 15th, 2023. When you look at this chart here, this chart is the S&P 500. It actually goes back to June of 2022. And you can see it's just been a big, volatile, sideways walk since about June of last year. We did have a dip in October, which was basically hitting our October lows, the low in this current market cycle. And the interesting thing when you're looking at this chart, a lot of people would say, well, it looks like we're kind of hit the bottom and we're coming out. But our concern is that many people are thinking that this run-up is actually the beginning of the bull market, but we think it could be a little bit premature. If you look at the leading economic and financial indicators, I think you're going to find a little bit of a different story, and a story that says, hey, caution is in the future here, at least for the next 3 to 6 months. Now, you can also see that the S&P 500 is up 7.21%. If you look at the aggregate bond fund, which really takes in all bonds in the U.S., they're up about 3.49%. And as you could imagine, it's a bit different than the previous year, and we'll talk a little bit about that. Now, when you're looking at the economic indicators, again, there's 20 indicators here, and it's looking at different economic and financial indicators that we look at to kind of forecast to see where we are today and where we're going in the future. And with this chart, when you look at it, there is positive speed dials, and those are the ones that are green, and as you can probably tell, there's no green right now. So let's move on to neutral. There is a lot of neutral, and there is, unfortunately, a lot of negative. And when you think about the changes from the previous month, and that's what we're looking at, you look at the hands for each one of the dials, and if it's a black hand, that's where we are today, or as of the end of, or the beginning of the month. And if you see any gray hands, that's where the dial was the previous month. And we really have 3 different changes here, 2 to the negative, 1 to the positive. Your disposable personal income is notched down a little bit. People are still spending out there, and unfortunately, they're spending within their reserves. But still, at a neutral state, not a bad thing at this point. The fiscal policy, that's gotten more into the neutral category, and I'm sure everybody is a little bit concerned with the debt right now and the spending that our government is doing with what seems to be no regard to how much debt they're putting us in. And then let's go on to inflation. Here's the good part. Inflation has come down a little bit. We're now at 4.9% as of April. Certainly we have not gotten the May numbers in yet, but 4.9% is a far cry from 9%, which was the high. So when you're looking at these indicators, we're really looking 6 to 9 months out. And if this is what it looks like 6 to 9 months from now and things are still trending worse, what it tells us is that we're not out of the woods from an economic cycle standpoint. We have not hit the bottom yet. Now again, this is not the stock market, this is the economic cycle that we're really looking at here, which forecasts where we're going in the future from the economy standpoint. Now, everybody has heard the talk about recession. We've talked about it a lot. If you look at where we are today, this chart is broken down into two separate charts. On the left-hand side, you have the economic cycle where it started out in the growth cycle in 2020, kind of peaked and is now coming down. We have not hit the bottom yet, and that's kind of what this chart shows. We have three potential outcomes. You know, when you look at the outlook here, you got slow growth, mild recession, or a normal recession. And I'm going to focus more on the mild recession because that's the highest risk right now. We're at about 64% chance of going into a mild recession. Now, what does that mean? It means that the GDP is likely to go negative in the upcoming months. And when you're looking at earnings growth, you're looking at, you know, 0 to negatives in the earnings growth. And obviously that's not the picture for a boom economy right now. Probably the bigger concern is that we have a 76% chance that we're going to hit some kind of recession, whether it be mild or a normal recession. Again, this is looking forward. When you think about the 20 economic indicators and then look at this chart, you really have to think that we are more, how would you say, Rocky, 3, 6, maybe even 9 months out before we hit the bottom of that economic cycle.
Yeah, probably the end of the year, kind of.
And it could very well be. And the concern or the thing that every client keeps talking to me about is, well, when are we going to hit the bottom and start, you know, back into a bull market? And it really comes down to those indicators. We're not seeing the indicators that are giving us that information, but I'll talk a little bit more about that in the next slides coming up. But yeah. You get to have the highlight of the topics here, and that's the debt ceiling and the challenges that are going on right now with that.
Yep. So let's move on. I want to do a little education here. Let's talk about the debt ceiling showdown, what's going on between Congress and the White House. But before we do that, let's jump into kind of get a overall understanding of what is the debt limit. Well, back in 1917, Congress enacted the debt ceiling limit, which is the amount of money, it limits the amount of money that the government can borrow. So it's got a little different, some people associate that with how much money's coming in. That really isn't how much money's coming in. Again, the country has revenues through taxes and things like that, and then beyond the normal revenues, they can go out and borrow to increase spending, and that's actually what was established way back in 1917 to limit Congress or the government's ability to go into debt. So that's what we're kind of talking about here. And what this chart is basically showing us is back at March of this year, the 450 billion on the left is kind of how much money it was estimated the government had to spend and how the spending was going. And as you can see, as these two lines represent, there's two different groups that basically are trying to forecast when the government's going to run out of money, and that's that zero line. So the top darker blue line is the Congressional Budget Office. They do their own measurements. They're responsible to Congress tracking the spending and the budget considerations. Anytime Congress is looking at doing something and allocating funds or whatever, they're using this to try to determine, do they have the funds to do it, or what do they have to do to keep their budget in line? On the converse side, the OMB baseline is the Office of Management and Budget, which reports to the president. And that's why you have these two different groups kind of trying to measure and say, hey, where are we going to be running out of money? Okay. What's interesting about this chart is, as you can see, going from March into April, the lines are going down, but then there's a spike up. Do you know what that spike up is, Dan?
That's a good question.
Yeah, well, it happens April 15th of every year. People have to pay their taxes.
Yeah.
So
Yeah.
what this is kind of neat to see how they show spending going down, but they expect that influx of revenues due to the taxes due at the end of the year. And then, as you can see, the spending starts drawing down on those reserves. And actually, the president's office, OMB, decided that looks like they calculate we're going to run out of money early June. And that's where Janet Yellen, I think, also came out and said that. We talk about that in the next slide, where the Congressional Budget Office has a little bit rosier picture, let's say, of where they see spending and how it's going. And their forecast was to run out of money basically mid-August. So this was back in like March timeframe. This was calculated by Capital Group, great research group out there. And it's just to kind of understand how they see spending flowing through the year, and why when there's two different groups that are kind of calculating things maybe a little differently, you know, they're coming up with some different answers of when we're going to run out of money. And that makes it confusing for us as citizens to say, why do I hear different numbers sometimes? Because it's different groups doing the projections. Now, CNR put this together, I think, in late April to kind of give a timeline of some of these expectations through the year. If you go back to January, literally in January, we were projecting running out of the initial $31.4 trillion back in January. However, there's things that the feds and the budget offices do to kind of move payments around and play with the budget in order to make the money, quote unquote, last longer. In March, you could see Biden delivered his budget proposal. In April...
Well, you know what? There's a funny thing, because if you think about that previous chart and how much the White House thinks that we're going to go into debt more, it could be because that budget proposal was an increase in spending by over $4 trillion.
Yeah.
So, I mean, that might be their thinking relative to that.
Yep. Also, the president is responsible to first come out with a budget proposal, and then Congress is supposed to come up with their budget proposal after that, and that's what happened in April, you can see here. Also, like I said on the previous chart, the receipt of income tax payments kind of can help extend that, and the things that the budget offices do to try to mitigate running out sooner, all those things started taking place. What else is interesting to note on this chart, in April, the Fitch ratings actually threatened to downgrade the U.S. debt back then, saying, hey, if you guys don't start acting on this, we're going to downgrade the credit rating of the United States. So that started to give some concern, and I think that's why we see a lot of volatility in the stock and bond markets even today. Excuse me.
So if we spend a lot more money, does the debt rating go up?
No.
I'm just wondering.
If we're allowed to spend more money, the debt rating goes up. We have to allow it first.
Oh,
So
okay.
That's what's
Now I
going
got
on.
it.
So back in June, or coming up in June, we're expecting, the quarterly tax payments from businesses. The estimated taxes come in. So that's an actual influx of money, which allows us, quote unquote, to extend that running out a little bit more. And that's why the numbers change too. It depends on what actual revenues are coming in from some of these events, like taxes in April or the quarterly estimated tax payments. Also, June is when Janet Yellen from the Fed came out and said, hey, this is when I think we're going to run out of money. The Fed's looking at this too. Okay, on the previous chart, I showed that the Congressional Budget Office originally said August. Well, a month later, with this chart came out, it actually pulled that in a full month. So they did change their numbers and revise them to be running out of money sooner. The other thing we noticed too in the credit markets and the bond markets, right now there's kind of a disconnect in the Treasury bill curve yield out there in August, and that's kind of where the bond market was expecting things, the government to run out of money, which impacts, the value of those bonds.
Right.
If the government defaults on bonds, guess what? Those bond values can go wild, right? It's gonna cause a lot of consternation in the market. So the markets themselves also are kind of predicting, definitely being out of money by August and forcing bond yields to go up significantly because the credit rating to those bonds will drop. This chart I thought is interesting to bring in because one of the questions I have is, well, what's happened in the past? And when you look at the last three major standoffs we had between Congress and the White House, you go back to 1995, what did the stock market do? There were actually 2 periods of government shutdowns, one for 5 days, and they extended it like a few weeks and then shut down again for another 21 days. But what happened to the stock market? Well, during that time, the stock market still went up. There was a slight drawdown at one point of negative 1%. It went up 1.3% in 1 month after they resolved the issues, and 12 months later, the market was up 20%. Same thing in 2013. We had a standoff that the government shut down for 16 days, okay? But it didn't have a major impact on the stock market. During the standoff, the market was up about 3%. It went down to about 5%. 1 month later, it was back up 4.5%, and 12 months later, up 8%. Okay. However, you notice I skipped over 2011. 2011, what happened then was the S&P actually downgraded the U.S. credit rating from a AAA to a AA, which shook the markets much more. That didn't happen previously or in 2013. So that impact, see what happened? The stock market went down over 5%. At one point it hit down 17%. A month later it was still down. Again, because those bond credit ratings got impacted so heavily, it took a while for that to work its way through the market. And you can still see though 12 months later, the market was up 10%. So the point of this chart is we're feeling a little bit like we're more like in a 2011 potential situation here, just because there's been threatenings of downgrading the credit ratings on the bonds if we default, which will further shake the markets. And we're protecting, Dan, from our portfolio perspective, we're protecting from this. So we're being defensive.
Yeah.
We're limiting the amount of risk in the portfolios on the bond side. We're in very short term, 1 to 3 year bonds or 1 to 3 month bonds.
Yeah.
We're in cash in many cases because cash is paying over 4% right now on some of our money markets accounts that we have. So we're trying to be defensive in anticipation of any kind of problems. We don't want to see another 2011 taking place moving forward. So,
well, and if you think about the bond market is like the oceans as opposed to the equity market, which is like the Great Lakes.
Yeah.
It's just that much bigger, and that's why the rippling effect through a bond market takes a whole lot longer to do so. Mm-hmm. So there's a lot going on out there right now. But again, I was talking to a client earlier that really about what's going on with the markets in the past. She's like, well, I'm 80 years old. How much time do I have left? And I'm like, well, really think about it over time. How many recessions have you gone through? And every one we came out of. How many equity crashes have we had? And every one of them we came out of. Mm-hmm. So it's really a matter of, I've said this before, when the markets are down, it's an opportunity. And there are a lot of big money managers that are thinking the same way. And that's why there is such a switch, such a wealth transfer during every market correction from the impatient to the patient.
Right.
From the people who don't have plans to the people who do have plans. And that's why planning is so, so important. So that being said, let's talk about the planning and the portfolio positioning we have. When you look at this chart, you've seen this chart before, and the markets are still in a position where I don't want to jump into equities. I'm not encouraged to go out and buy equities right now. And the reason is when you look at the S&P 500 forward price earnings ratio, we're like right in between fairly priced and overvalued, even at this point in the market. And if you think like an investor, or especially an institutional investor, they're really waiting for things to go on sale, and they're just not on sale yet. The blue area is attractive in this chart. The very attractive part is the green area. This is where the money managers really want to see the PE ratio go so they can buy at a discount and then write it back up. And when you think about the earnings estimates or the growth estimates, the overall consensus in the market is that we're going to have about a 1% growth. But when you take in all the weighted averages that City National Rockdale looks at, they're thinking more of a negative 3.5 to a negative 5 if we end up in a mild recession, which again is likely. So the price earnings ratio really has to come down quite a bit before the big money moves in and we start seeing a capitulation in the market. So the whole thing here is let's wait for the opportunity. That's why we've got ourselves in defensive positions with treasuries, and we're just waiting for that opportunity for the market to capitulate so we can activate these strategies, and then let's reap the rewards from them. From a fixed income performance standpoint, this year actually bodes a whole lot better than last year. In here it says the performance has been consistent, and you could probably say that from 2022 and for 2023 year to date. 2022, well, it's consistently bad. 2023, we're off to a very good start from a fixed income standpoint. And when you think about the different asset categories, the chart on the right-hand side shows that the corporate and the municipal high yield tend to have higher returns than the corporate investment grade and the municipal, boy, I'm a little bit tongue-tied today, the municipal investment grade, which is a lower rate of return. But you can also see the risk is lower on investment grade and the risk and volatility is higher on the high yield. So you really got to pick your poison when you're getting into yields and bonds as to what your risk tolerance will allow you to do and stay the course. But the good news is we've got much higher returns in bonds, and like Rocky had said, our fixed money market accounts are producing over 4.5%. And the laddered treasury portfolios are right around the same performance. So they're performing the way we want to. They're stabilizing the portfolio. So if we do have a downturn, we will be ready to act on that and really capture all we can capture on that downturn. Now, looking at the macro uncertainties, this is the reason why we are still defensive in our portfolies. And on this chart, you've got the right side, which is the optimistic, and the left side of this chart, which is, reasons to be wary. So let's go through those real quick. First, you've got the geopolitical risk. It still remains high. Nothing's changing there. There's downward earnings on really a lot of the corporate announcements out there right now. So their revisions are going downward. We expect that to continue as the recession kind of develops here. The Feds are likely to stay higher for longer. What does that mean? They're not planning on lowering the Fed rates anytime soon. So we expect it to stay higher in 2023. Then the bank stress. I'm constantly getting questions about what's going on with the banks. Are they safe? What do we do with our money? And certainly those are legitimate questions that we have to address. We do have options. We do have alternatives that can really put people at ease. So we can always talk about that as you come in. And the normal recession risk is increasing, as we talked about. Rocky went through a good explanation of the debt ceiling standoff, but that's still there, and until it's resolved, it's on the wary side. And then, again, like I had talked about, the valuations are still not cheap enough for the big investors to get in. Looking at the optimistic side, well, the list isn't quite as long. We do know that the recession is likely to be mild. That's a good thing. Consumers are resilient. They've got some reserves so they can kind of weather the storm, and the corporate balance sheets are solid. The bear market close to historical average length looks like it's going to be shorter than the average, so that's a good thing as well. And then the valuations, as we had talked about, the companies are repricing downward because they don't expect to have the profits that they've had in the past. So that was where we are, or where we were. Let's look at the portfolio positioning recap. We re-entered the bond markets. We used to have a lot of cash in 2022. Fixed income yields are up. We've got into laddered treasuries because now they're over 4%. There are signs that fixed income has bottomed and is moving forward. So that's not to say we're out of this secular bear market for bonds. It just means we're in a mini bull market for the bonds at this point. Watch for leveling off from the markets to start somewhere around Q3. And that is kind of contingent on what the Fed does and whether they stop increasing rates. We continue to slightly underweight equities, but we are always adding quality. We have added value stocks to the portfolios, reduced the growth stocks to a percentage lower than where we were before. So again, the value stocks, we've got high dividends in there. It's a little bit more of a stabilizer than growth stocks right now. We do look to expand in the quality of growth companies in Q3 and Q4. Again, we're estimating that we will hit the bottom and then start moving forward, so more equities would go into the portfolio at that point. Repositioning the portfolio will be based on individual clients' goals and needs, so keep that in mind. When we're looking at everybody's accounts, we're looking at every individual portfolio, their risk for the client, and then repositioning on it. And as most of you probably know, you've got more income type portfolios than you've had in the past. A lot of short-term laddered treasuries and corporate bonds all being actively managed. The income and growth, the value stocks, and corporate and high yield bonds are more of the portfolio than they have been in the past, so there has been a repositioning there. But think about it from the growth side. We are looking to add quality global growth stocks to the U.S. growth portfolio in the allocation. So we will be selective as we go through and do that. And then we expect a moderate equity volatility throughout the rest of the year. When I say moderate, boy, what do I really mean by that? Because it hasn't been moderate yet. It's been kind of volatile. But it should moderate a little bit because we've really structured the portfolios with the laddered treasuries and more cash with the money markets, which helps stabilize the portfolios. Really good for the growth and the stabilization of the portfolios.
Yeah.
Well, that was a mouthful, huh?
Yeah, I think one of the reasons the portfolios can stabilize a little bit is we've got some yield now off of the fixed income that we didn't have a year or two ago. So if you can make 4% there and relatively low risk, that allows you to balance out and pick up some growth that might not produce today, but might be the winners in a year from now.
Absolutely.
Or 2 years from now.
Absolutely.
So
Makes sense. Makes sense. So, you know what? That kind of brings us here.
yeah.
We have solutions. When you're looking at our company, we are a full wealth management firm. It's not just the investment consulting. That certainly is the fuel that allows us to do all the advanced planning, things like wealth enhancement, wealth transfers, wealth protection, and certainly, let us not forget, charitable giving. All these different strategies we can employ for clients to enhance their net rate of return so they end up keeping more in their pockets. So if you want to find out more, you can go to Daniel Krug and Associates YouTube channel. One of the easiest ways to get there is just go to mydkna.com, our website, click on Watch Us, then DKNA YouTube, and it'll take you directly to the videos. And you can watch the full-length videos, or you can watch the snackable videos, which generally are 2 to 5 minutes. So that being said, you know, let's have a great month, Rocky, and you take care of your family, and
We'll take care of you guys. Thank you for joining us today.
yeah, this was great.